Let's pick up on the markets now. Investors bracing themselves for yet another turbulent start to the trading week after the JSE lost nearly 3% on Friday in its biggest one-day decline since mid-June amid the deepening fears of a global economic contraction. Lesedi Mabuza is Sentio Capital, and she is an equity analyst there, joining us now to talk to us about how the JSE is shaping up in early trade. Lesedi, good morning to you. Let's kick off the conversation with the Rand, which breached that 18 Rand against the dollar mark, while the pound plunged to record lows. Talk us through the factors influencing these moves.
I mean, with the Rand, this morning we saw it breach 18 and actually touch 18.10 early this morning. And it's quite scary because when you think when last we saw these kind of numbers, it was during COVID, where the Rand topped at around 19. And the main reason why you're seeing such weakness in the Rand is currently at the moment and globally, you are seeing risk-off trading sentiment at the moment with a lot of negativity and recession fears. Therefore, you're seeing a much stronger dollar against our currency, hence the weakness. But you can't only and solely blame the dollar strength. Us in South Africa, we also have our own problems. We're still entering a week with load shedding, stage 4 load shedding. And obviously this isn't good for the economy. It's not good for growth. I'm sure a lot of your smaller companies are struggling. And this combined with increased rate hikes, therefore less money in consumer wallets, means they're not going to be spending as much. And this further just increases the no growth factor, or the low growth factor. Yeah.
Let's talk commodities. Oil prices rising modestly in early trade on Monday after sliding to an 8-month low last week. What's driving the uptick?
So what's happening at the moment? You're seeing a lot of decline in the oil market, and this is after last week the oil commodities slumped to an 8-month low last week. Down 5 on the day, I think on Friday. And what's weighing these prices down is that you're seeing a surging dollar, as I said before, and also investors are fearful that a lot of central banks globally are hiking aggressively and sharply. And this puts fear in investors' eyes that this will increase the chance of a recession and obviously hit fuel demand. And even looking at the dollar index, I mean, the dollar index increased to a 20-year high this morning, and this further adds more woes or negativity to your oil prices. But I do think that your oil prices will get some support, especially as you see that Russia continues to put more troops into the Ukraine war, as well as the EU sanctions on Russian oil that are still set to be into effect in December. And it's something I think that's very key to watch out for the next month, that contrast between the EU sanctions as well as lower demand. But I do think that it will tilt to the EU sanctions, as it's very hard for Europe just to replace Russian oil overnight. They have to go through a lot of sources and go through a lot of ways just to get that oil, as they've had it easy over the past years. And just even thinking of these negative prices, one thinks to what OPEC Plus will do. Yeah. So they will be meeting on the 5th of December. And if you remember at the last meeting, they slightly cut their production output. So with these lower prices, it will be interesting what their decision will do in terms of oil output for the market.
Let's talk company news a little bit. Apple starting to make its iPhone 14. Wait for it. It is being made in India as opposed to China. So you're going to explain to us the implications of that move and whether or not it is still the Trump clampdown on China that is manifesting here.
So just to comment, so India has been making some of the iPhone models, but they've been making the older versions and the older legacy type of models there in India. And the decision now, obviously, they have decided to assemble the newer iPhone 14 models in India. And what I think this is, I think the companies are the company Apple is trying to reduce its reliance on China, along with other companies such as Samsung and as well as the people that make Oppo cell phones. And the reason for this is that you've seen a lot of political instability in China for the past year, especially with the zero COVID policy. It's been very disruptive for these big companies. You even saw Apple, I think last year, come out with a reduced sales guidance because of the lockdowns. They weren't able to manufacture enough cell phones to meet their forecasts. So I do think that they are trying to reduce that overall risk for the future from China. And a lot of analysts are saying that India will be the next big manufacturing hub globally. And I think there's less there's more political stability in terms of regulations, and also they still get the benefit of having cheap labor. So it is not a good thing for China, as you are taking a lot of the manufacturing growth in the country away from them into India. But at the end of the day, the companies have to make decisions. They have to make choices for what's right for them in terms of their future.
Yeah, it'll be interesting to see whether that is going to sustain that Apple moving their business to India as opposed to China. Let's conclude the conversation with the quarterly employment statistics for the month of June expected out tomorrow. What should we expect from those numbers?
So just to recap for the listeners, the quarterly employment stat is an enterprise-based survey that collects info from non-agricultural organizations or businesses. So overall, we are still below the 2020 quarter one levels, even though you did see an increase in employment of 0.4% from December 2021 to March 2022. And a lot of this growth was mostly tilted to part-time jobs. Just looking at the data, you are seeing that full-time employment is lagging part-time employment. And I think it sort of shows the kind of uncertain environment that we are in right now, coupled with load shedding, some sectors still trying to recover and so forth. But I do think that going into these numbers tomorrow, you'd still continue to see employment growth, but I think it will still be tilted towards your part-time employment growth, especially with sectors that were impacted heavily by COVID still recovering. And sectors I mean by like your travel industry and your restaurant industry, they more lean towards your part-time employment. Yeah. You are starting to see those sectors recover a lot better this year compared to last year. So I do think that's why you'll see those employment numbers tilted towards part-time.
Lesedi Mabuza, thank you very much for that markets update at Sentio Capital, an equity analyst.